The loss that hurts your ego today is the loss that protects your wealth tomorrow. Most investors think the market punishes mistakes. It doesn't. The market punishes unwillingness to admit mistakes. A small loss feels like failure in the moment. It feels like you misjudged. It feels like you weren't as smart as you thought. But here's the uncomfortable truth. A controlled loss is not defeat. It is surgical precision. Surgeons cut to remove infection. Firefighters burn small patches to stop wildfires. Military generals retreat to win wars. In every high-stakes domain, strategic withdrawal preserves long-term survival. Yet in investing, people treat retreat as weakness. They cling, they hope, they defend. And hope is not a risk management strategy. A small cut, taken early, is not about avoiding pain. It is about preventing fatal damage. Because in markets, it is rarely the first mistake that destroys you. It is the refusal to close it. And that refusal doesn't just cost money. It costs flexibility. It costs clarity. It costs time. You can recover from a small loss in weeks. Recovering from a catastrophic drawdown can take years. If you want to stay in this game long enough to compound wealth, you must learn something counterintuitive. Pain, applied early and deliberately, is cheaper than denial applied late. The investors who survive decades are not the ones who avoid being wrong. They are the ones who accept being wrong quickly. Because the cleanest portfolios are not built on perfect predictions. They are built on disciplined exits. And sometimes, the most profitable decision you make is the one that protects you from yourself. There is a sentence that has destroyed more portfolios than recessions, wars, or rate hikes. I'll wait for it to come back. It sounds reasonable. It feels patient. It even feels disciplined. But most of the time, it is not discipline. It is denial disguised as patience. Retail investors are taught to think long-term, which is correct. They are told markets recover, which is also correct. They are shown charts that always trend upward over decades. Again, correct. But here's what no one emphasizes. Markets recover. Individual positions often do not. An index can rise while your capital remains trapped in dead assets. There are companies that never come back. There are tokens that never recover. There are sectors that remain irrelevant for a decade. Waiting is not always wisdom. Sometimes waiting is slow destruction. Professional investors understand something uncomfortable. Small losses are not failures. They are operating expenses. If you cannot take small losses, you will eventually take catastrophic ones. In forestry management, small controlled fires are intentionally set. Why? Because without them, dry fuel accumulates, and when the real fire comes, it becomes uncontrollable. Portfolios work the same way. If you refuse to cut small losses, you accumulate risk concentration, emotional bias, and capital stagnation. Eventually, one large event wipes out years of progress. Let me break this down structurally. 1. The mathematics of damage. Losses are asymmetrical. A 10% loss requires an 11% gain to recover. A 25% loss requires a 33% gain. A 50% loss requires a 100% gain. A 70% loss requires a 233% gain. Large drawdowns are exponentially destructive. Small losses are linear. The difference between losing 8% early and losing 48% later is not emotional. It is mathematical survival. Veteran investors focus on drawdown control, not return maximization, because survival compounds. Most investors don't hold losers because they believe in fundamentals. They hold because selling makes the loss real. They want to be right. They fear regret if it rebounds. They anchor to their entry price. This is not analysis. This is ego protection. The market does not care about your entry price. The market does not know you exist. A professional asks one question only. If I had no position today, would I buy this now? If the answer is no, Why are you still holding it? Capital is oxygen. When capital is trapped in a declining asset, you are not just losing money, you are losing opportunity. Let's say you hold a position down 35%. You tell yourself, I'll sell when it gets back to break even. But during those 18 months of waiting, 3 higher quality setups appear. A new sector rotation begins. A macro shift changes the game, and you cannot participate. Small losses free capital. Free capital creates optionality. Optionality is one of the most powerful hidden assets in investing. Losses that are not cut tend to grow. As they grow, they become heavier in emotional weight. You begin rationalizing. You average down. You defend your thesis. You commit more capital. Now your portfolio is no longer diversified. It is emotionally concentrated, and concentrated risk without conviction is lethal. Professionals cut small losses before they become thesis-defining events. Think of small losses as insurance premiums. You pay small amounts regularly to avoid catastrophic destruction. Insurance feels annoying until you need it. The disciplined investor pays many small premiums. The undisciplined investor pays one massive bill, and that bill usually arrives during panic, when liquidity disappears. Small losses are not evidence that you are bad at investing. They are evidence that you are still alive in the game. The only investors who never take small losses are the ones heading toward a large one. Pause. Breathe. You are not supposed to be right all the time. You are supposed to be solvent. Deep structure. The survival pyramid. Over decades in markets, I learned that investing has a hierarchy. From bottom to top, survival, capital preservation, compounding, optimization, aggressive growth. Most beginners start at the top. Professionals start at the bottom. If survival is compromised, nothing above matters. Small losses protect level 1. Without level 1, the pyramid collapses. Say case study, the 2 investors. Investor A refuses to sell. He holds a position down 20%. It drops to 40%. He averages down. It drops to 65%. Now, he is emotionally paralyzed. His capital is locked. He avoids opening his account. He cannot act when real opportunity appears. Investor B cuts at negative 10%. He reallocates. 2 trades fail, another small loss. Then 1 setup works. He compounds. He remains flexible. 5 years later, Investor B is calm and solvent. Investor A is explaining why it was just bad timing. The difference was not intelligence. It was tolerance for small pain. Why this is so hard? Because small losses hurt your identity. You thought you saw something. You built a narrative. You told friends. You felt confident. Selling feels like admitting you were wrong. But here is a brutal truth. Markets reward adaptability, not pride. Professional money managers are wrong constantly, but they are wrong small. That is the entire edge. The first uncomfortable question. Ask yourself honestly, do I avoid small losses because of logic or because I want to protect my ego? If the answer is ego, you are not investing. You are performing, and the market punishes performance. Small losses only work if they are small by design. This is where most investors misunderstand risk. They think risk is about picking good assets. Risk is actually about position sizing. Before you enter a trade, 3 decisions must already be made. How much of the portfolio will this position represent? At what price is my thesis invalid? How much total portfolio damage am I willing to tolerate? Professionals answer these questions before capital is deployed. Amateurs answer them after the loss begins. That difference defines survival. Let me show you how professionals think. If a portfolio is $1 million and the investor risks 1% per position, the maximum planned loss is $10,000. That means if the stop is 10% away, position size is $100,000. If the stop is 5% away, position size is $200,000. If volatility requires a 20% stop, position size shrinks to $50,000. The risk per idea stays constant. This is the firewall. It ensures that no single mistake becomes existential. Retail investors often reverse this logic. They choose the position size first, emotionally, and only later think about risk. That is not investing. That is gambling with narrative confidence. Small losses are not about being pessimistic. They are about designing a portfolio that can survive being wrong repeatedly, because you will be wrong repeatedly. There is a dangerous confusion in investing culture. Holding through volatility is praised, conviction is admired, long-term belief is celebrated, and sometimes that is correct. But here's the distinction professionals understand. Conviction is thesis-based. Stubbornness is ego-based. Conviction says, the fundamentals remain intact. The price decline is noise. Stubbornness says, I refuse to admit I was wrong. Conviction adapts when new data arrives. Stubbornness defends old beliefs at any cost. How do you tell the difference? Ask this. If I had zero position today and the stock looked like this, with this chart, this balance sheet, this macro environment, would I initiate it? If the honest answer is no, you are not holding out of conviction. You are defending your past self. Markets do not reward loyalty, they reward accuracy, and accuracy requires revision. Small losses are simply early revisions. Many investors avoid cutting losses because they confuse volatility with invalidation. Price drops 8% in a week. They panic. Or worse, they freeze. But volatility is not the same as structural failure. Professionals distinguish between normal price fluctuation, liquidity-driven volatility, macro regime shifts, and fundamental thesis breakdown. A small loss rule does not mean reacting to every red candle. It means defining in advance. What invalidates my idea? Is it a technical level? Is it earnings deterioration? Is it regulatory change? Is it liquidity collapse? Once that line is crossed, the exit is mechanical, emotion is removed. Small losses only save portfolios when exits are rule-based. Without rules, small losses turn into large rationalizations. Most investors focus on return percentage. Professionals focus on drawdown depth. Why? Because compounding is nonlinear. Imagine two investors over 10 years. Investor A gains 25%, loses 40%, gains 35%, loses 30%. Investor B gains 15%, loses 8%, gains 18%, loses 6%. Investor A feels brilliant during rallies, but large drawdowns cripple recovery. Investor B feels boring, but shallow drawdowns allow steady compounding. Over a decade, Investor B often wins, because avoiding deep holes is more important than hitting home runs. Small losses flatten drawdowns. Flattened drawdowns accelerate recovery. Accelerated recovery compounds faster. This is the silent mathematics no one advertises. Here is a brutal market reality. You can only take small losses while liquidity exists. During crashes, liquidity disappears, bids vanish, spreads widen, selling becomes difficult. The time to exit is when it feels unnecessary, not when panic has begun. Small losses are strategic retreats. Large losses are forced evacuations. Professionals exit early, not because they fear volatility, but because they understand liquidity cycles. The crowd exits late, and late exits are expensive. Most investors secretly want validation. They want to say, I saw it before everyone else. I held through the dip. I believed when others doubted. But markets do not reward narrative heroism. They reward durability. A durable investor survives bad cycles, preserves capital, adapts to new regimes, keeps emotional stability intact. Small losses protect identity, not ego identity, operational identity, the identity of someone who will still be here in 20 years. Here is the insight that permanently changes how you see investing. Losses are not the problem. Uncontrolled losses are the problem. Every profitable strategy in existence includes losses. Every legendary investor has losing trades. The difference is structure. Small losses are embedded in the system. They are anticipated, budgeted, engineered. If you attempt to eliminate losses entirely, you will eliminate flexibility. And when flexibility disappears, fragility increases. Small losses are anti-fragility mechanisms. They make the portfolio stronger by removing weak exposures early. This is not emotional advice. This is structural engineering. If you attempt to eliminate losses entirely, you will eliminate flexibility. And when flexibility disappears, fragility increases. Small losses are anti-fragility mechanisms. If your portfolio dropped 12% tomorrow, would you A. freeze and hope, B. average down emotionally, C. execute your pre-written risk plan calmly? Your answer reveals whether small losses are philosophy or operating system. Professional investors write exit plans when they are calm, because panic is not a good architect. You do not go bankrupt from small losses. You go bankrupt from refusing to accept them. You do not destroy portfolios by being wrong. You destroy portfolios by being wrong and staying wrong. You do not lose wealth because markets fluctuate. You lose wealth because you refuse to respond. Small losses are humility in action, and humility compounds. There is nothing glamorous about cutting a position at -7%. No headlines, no adrenaline, no heroic story, just discipline. But discipline, repeated for decades, outperforms brilliance that refuses to retreat. The investor who survives outlasts the investor who insists on being right. And in markets, time is the ultimate multiplier. Small losses buy time. Time builds wealth. No further instruction needed.